Institution Mobile, quality e-learning experience on the go.
In preparing the trading profit and loss accounts and the balance sheets, several adjustments are inevitable. 1. Overtrading. Overtrading is a term that simply occurs when a firm is engaged in buying too much and selling too little. As such, the current assets in form of cash is being tied down while the stock at hand is also surplus. 1. It shows that there are so many creditors and there is surplus of stock, there is excess of the use of bank overdrafts. It simply means money paid in advance for services that have not been enjoyed. It could be in two forms. We could have prepaid expenses and prepaid income. As for prepaid expenses, this is the money paid in advance for an expense that has not actually been incurred. Prepaid income is actually money that has been received from customers for services that has not been rendered. In the book of the sole trader, prepaid income is a liability, while prepaid expenses is an asset. Another adjustment is accruals. Accruals means in the indebtedness of a business enterprise. It could be in two forms. We could have accrued expenses and accrued income. Accrued income is actually the owings by debtors to a business enterprise, while accrued expenses could mean the indebtedness of a company to its suppliers or creditors. They must be properly adjusted for in the books of the sole trader. Another adjustment is the provisions. Provisions. We could have provisions for bad debts, provisions for discounts allowed, and discounts received. Now, for discounts allowed, provisions for discounts allowed, it is normal that business enterprise over time will give a reduction on the sales of goods to their customers as a result of frequent patronage. As such, the accounts of the debtors might be overstated in the balance sheet. This necessitated a reason to adjust the discount allowed on the balance of the debtors before getting the real balance of debtors, while discounts received is actually given by the suppliers to the company. This must be properly adjusted in the books of the suppliers to get actual amount of purchases. Provision for depreciation of fixed assets. What is depreciation? Depreciation can be defined as the reduction in the economic value of an asset as a result of wears, tears, usage, and passage of time. Based on the JAMB syllabus, two methods of depreciation are recognized, namely the straight line method and the reducing balance method or diminishing balance method. First, the straight line method. This method makes provision for equal amounts to be charged as depreciation on yearly basis. The formula for calculating the rate is cost minus scrap value divided by the number of useful years. Cost is the amount the asset was bought initially. The scrap value is the present market value of the asset, having made provisions for depreciation, while the number of useful years is understandable. The second method is reducing balance method. This method has a fixed percentage written off in a diminishing form on the assets. The formula for calculating the rate is 1 minus square root of n residual value divided by cost.
Fusion Mobile, quality e-learning experience on the go.